Welcome to the Opening Bell Report.
This analysis report examines AMC Entertainment's operations, arguing that strong top-line revenue and record per-patron spending offer a bullish counter-narrative to the company's massive debt and struggling stock price.
It really leans into this idea of the AMC comeback, specifically how top-line revenue hits record highs.
Let's look closely at the section discussing AMC's revenue growth compared to competitors to dive right into our first piece of feedback.
Sounds good. Where should we start?
Right out of the gate, the material highlights a very specific data point. It points out that the trailing 12 months revenue has hit an impressive $4.85 billion.
Yeah, that is a staggering amount of cash.
It is. And it notes that this represents a 4.6% year-over-year sales growth.
Right.
Then it immediately sets this up against the lead competitor, Cinemark, pointing out that Cinemark only managed a 2.1% year-over-year revenue growth during that exact same period.
Okay, so a direct comparison.
Exactly. From this specific gap in the numbers, the analysis report draws the conclusion that AMC is actively capturing a larger share of the overall box office.
I see.
Essentially, it frames AMC as the undisputed heavyweight in the exhibition space because it completely eclipses Cinemark's $3.11 billion in raw revenue. As I understand it from the notes, the argument here is that AMC's sheer volume outpaces the competition.
That's clearly laid out. I wonder, though, if we've considered the full picture when we look at those numbers.
What do you mean by the full picture?
Well, the comparison between AMC and Cinemark provides a solid baseline for market dominance, but relying solely on top-line revenue growth percentages paints an incomplete picture of true competitive advantage.
Oh, I see exactly what you mean. The weakness here is that it treats that raw sales growth as absolute, definitive proof of an operational victory.
Yes, exactly.
By simply placing AMC's 4.6% growth next to Cinemark's 2.1%, the analysis report presents this as a very black and white win.
Right, but sophisticated investors look right past that.
Because this approach completely omits the crucial operational contexts that dictate how a business actually functions.
Yeah, like it doesn't account for location counts at all, or the difference between domestic versus international footprints.
Or the overall operational efficiency of the theaters themselves.
Precisely. Without introducing these highly relevant variables, a higher raw revenue figure, or even a slight edge in top-line growth percentage, does not necessarily mean AMC is operating a fundamentally better or more dominant business on a per-theater basis.
It could literally just mean they have way more doors open.
Which costs significantly more money to maintain.
Right, if I open 100 lemonade stands and you open 10, I'm obviously going to have higher top-line revenue.
But if your 10 stands are packed with customers and mine are empty, you have the better business model.
Exactly. So how do we fix this in the text?
Broaden the competitive analysis to include efficiency and scale metrics alongside sheer volume to make the market dominance claim bulletproof and more robust for sophisticated investors.
I like that. If we weave in those deeper efficiency indicators, it transforms the argument from just pointing out gross scale to building a robust, defensible thesis that holds up under intense scrutiny.
We want to prove the underlying engine of the business is outperforming the competition, not just that the vehicle itself is physically larger.
So, practically speaking, how do they build that into the material?
One straightforward way is to seamlessly drop in a revenue per screen or an attendance per location metric.
Think about it. You take that massive $4.85 billion revenue and you divide it by the thousands of screens AMC operates worldwide.
And then you find that exact same specific ratio for Cinemark.
Exactly. If AMC is actually generating more revenue per screen, then this dominance claim is immensely strengthened.
Proves they aren't just bigger, they are actually better at extracting value from their real estate.
Now, if they aren't outperforming on a per-screen basis, that's fine too, but the analysis report needs to add that necessary layer of nuance regarding the sheer cost of maintaining that massive volume.
That's a brilliant way to frame it. Building on that, another highly effective approach would be to briefly contextualize that 4.6% growth against the overall industry box office recovery.
Oh, that is such a critical benchmark that often gets overlooked in these types of write-ups.
What if the broader industry box office actually grew by 5% during that specific period?
If that's the case, AMC's 4.6% growth would actually indicate a slight loss of overall market share.
Despite the positive raw number.
Exactly.
But conversely, if the overall industry only grew by 2%, then AMC is genuinely capturing outsized growth. They are actively taking share away from competitors.
Establishing that industry baseline gives the percentage growth its true meaning. Without it, the 4.6% is just floating in a vacuum.
And speaking of vacuums, we also have to pull geography into the mix.
Good point. The analysis report really should acknowledge geographic differences here. AMC has a massive international presence.
Yeah, they made that huge Odeon Cinemas acquisition in Europe years ago.
Cinemark, on the other hand, has a footprint that is heavily weighted toward Latin America and domestic markets.
So the question is AMC's international presence disproportionately driving that $4.85 billion figure compared to Cinemark's specific footprint?
Clarifying that provides a much sharper picture of where the actual dominance is occurring.
And it prevents the target audience from making a false apples-to-apples comparison of purely domestic operations.
It absolutely does. You want the analysis to be as precise as possible, and breaking down the geography is a fantastic way to do that.
That covers the sheer volume of the business pretty well. But let's look at the actual people sitting in the seats. The analysis report calls this AMC's secret weapon.
Okay, so what I really like about this part is how clearly it defines the transformation of the theater into a high-spend experience.
The numbers in this section are just wild.
The material highlights a totally fascinating metric, a record $22.10 in total revenue generated per patron.
That is a staggering number for a single moviegoer.
And the material details exactly how this is happening. It points to aggressive upselling, it highlights the consumer's willingness to upgrade to premium formats like IMAX and Dolby Cinema.
And of course, it mentions the strategic rollout of highly viral, exclusive theatrical merchandise.
We're talking about those incredibly popular popcorn buckets.
Oh yeah, those buckets are everywhere.
The takeaway presented here is that management has successfully shifted the business model from a simple ticket transaction into a premium entertainment experience.
That's fascinating. What are the potential limitations or counter-arguments to that idea?
Well, the spotlight on the record $22.10 per patron spending effectively captures AMC's recent upselling triumphs, though it leaves the long-term sustainability of this consumer behavior unquestioned.
That is the exact blind spot here. The analysis report treats these premium upgrades and high-margin merchandise sales as a perpetual, uninterrupted growth engine.
Right. It basically presents this $22 metric as a new permanent baseline,
completely failing to explore any macroeconomic vulnerabilities, consumer fatigue, or the natural ceiling of discretionary spending.
It essentially assumes that patrons will indefinitely continue paying premium prices for popcorn buckets and upgraded seats without any pushback whatsoever.
Which, when evaluating the long-term viability of an operational turnaround, is a pretty critical oversight.
It is a massive assumption. It completely ignores the ceiling of discretionary spending.
When you're looking at an operational turnaround, you have to look at the ceiling, not just the floor. Introduce a forward-looking risk assessment regarding consumer spending elasticity to balance the bullish enthusiasm and demonstrate a comprehensive understanding of market dynamics.
Proactively addressing the potential limits of this per-patron spending doesn't take away from how impressive that $22 metric is.
No, not at all. Rather, it grounds the analysis in economic reality. It shows the sophisticated awareness that consumer behavior is incredibly fluid and subject to all sorts of external pressures.
I mean, we've all been there, right? You buy the ticket, but then you see that exclusive Wolverine popcorn bucket.
And suddenly you're out $35 before the trailers even start.
Exactly. But how many times a year can the average household do that?
If they really want to make this analysis report bulletproof, they need to ask, how elastic is this spending? What happens if consumers just stop wanting to pay $20 for a plastic bucket?
A great way to implement this is to add a brief sensitivity analysis.
Or even just a future projection.
The text should directly address what happens to AMC's underlying operational thesis if this per-patron spend plateaus right at $22.10.
Or what the financial impact looks like if it slightly retracts. Say it drops down to $19.
Modeling a base case and a bear case alongside this super bullish metric shows a much deeper level of financial rigor.
Yes, absolutely. And you have to factor in the broader economy. Explicitly mentioning macroeconomic headwinds is vital here.
Elements like persistent inflation, rising interest rates, or tightening household budgets. Those traditionally impact high-margin concession and merchandise sales long before they ever impact the base ticket sale.
When consumers feel a pinch in their wallets, they still go to the movies. They still want that escape.
But they skip the branded popcorn bucket. They skip the premium large format upgrade.
Integrating a discussion on how inflation might compress that $22 metric adds immense credibility to the fundamental analysis.
And there's another major dependency here that needs to be discussed. The sheer reliance on the Hollywood slate itself to drive this specific behavior.
Oh, that's a fantastic point.
The analysis report really should clarify that this $22.10 metric might be heavily dependent on event-driven blockbuster releases.
The films that generate massive cultural virality are the ones that demand exclusive merchandise and premium format viewing.
If the upcoming theatrical slate hits a dry spell, or if the studios rely more on smaller, non-event films, that high-spend consumer behavior is naturally going to dip.
Right, you aren't buying a special commemorative bucket for a quiet indie drama.
Acknowledging that this secret weapon is deeply tethered to the quality and scale of studio output creates a much more balanced, accurate picture of the operational reality.
It proves the analysis understands the entire ecosystem, not just the numbers on a spreadsheet.
Which actually transitions us perfectly into the most crucial juncture of the analysis report.
The point where this operational success crashes into the reality of the stock price.
Exactly.
The material makes a strong case for the underlying business by highlighting this massive revenue, but then abruptly shifts to the reality of the balance sheet.
In a section titled, The Reality Check. Right. It notes a massive $3.49 billion debt overhang.
It mentions that despite the impressive top-line revenue, bloated lease structures, and the sheer cost of servicing this debt, drag the company into unprofitability.
We're looking at a free cash flow margin of negative 7.5% over the last year.
Ultimately, it concludes that the business generates cash, but it flows to bondholders rather than shareholders.
Which is why the stock price is hovering near the $1.17 mark.
Is the connection between the top-line revenue and the negative free cash flow fully established in the material, or is that an area to potentially bolster?
The transition from celebrating nearly $5 billion in revenue to explaining a stock price hovering near $1 feels abrupt because the exact mechanics of how that cash is drained remain abstract.
Abstract is the perfect word for it. The structural weakness here is palpable.
The analysis report introduces the debt overhang and the unprofitability almost as an entirely separate phenomenon from the revenue generation.
Sure, it states the fact that cash goes to bondholders and interest expenses.
But it jumps straight from the $4.85 billion in gross revenue all the way down to a negative 7.5% free cash flow margin without showing any of the intermediate steps.
This leaves a significant structural gap in understanding for the target audience.
The precise reason why the business model fails to generate profit, despite that record per patron spending we just talked about, remains a total mystery.
The mechanics of the cash drain are stated, but they aren't structurally demonstrated.
It leaves a massive gap. If you want to fix this, you have to show the math.
Map the step-by-step financial journey from the massive top-line revenue down to the negative free cash flow to clearly illustrate the exact gravity of the company's financial obligations.
Clearly illustrating the exact sequence of how the money is spent reveals the true weight of the company's financial obligations.
It transforms a jarring transition into a logical, inevitable descent.
It bridges the disconnect between the operational comeback and the struggling balance sheet.
So how do we do that in a written analysis report without losing the target audience in the weeds?
The most powerful tool here is to utilize a financial waterfall description in the text.
You don't just throw out the final negative number.
You start clearly at the top with the $4.85 billion. Then, you walk them through the subtractions. First, briefly subtract the standard, unavoidable operational costs.
Specifically mention as studio cuts for film rent.
You have to explain that right off the bat. A huge chunk of that ticket sale doesn't even stay in the building. It goes straight back to the studios in California.
That film rent is a massive, unavoidable haircut right at the top of the waterfall.
Right. And then, you subtract the theater staff and the basic overhead to keep the lights on.
And then you hit them with the heavyweights.
Exactly. Next, you highlight the specific, massive percentage taken by those bloated lease structures.
The exhibition business is basically a real estate business. Those leases are fixed costs that don't care if the theater is full or empty.
And finally, you spotlight the exact dollar amount of the annual interest payments required to service that $3.49 billion debt.
If you build out a financial waterfall, you can literally watch that massive $5 billion get eaten alive.
By the time you hit the bottom line, it's completely gone. Showing that math visually, step by step, makes the negative cash flow mathematically tangible.
It makes it painfully real. And to really drive that point home, the analysis report should contrast AMC's interest expense ratio with a healthy competitor's.
Oh, that's a great idea. Imagine showing exactly what percentage of AMC's revenue is dedicated purely to servicing past debt, and then comparing that to the percentage a company without a distressed balance sheet pays.
That highlights exactly how much of a penalty AMC is enduring right now.
It emphasizes that they are running a race with incredibly heavy weights tied to their ankles.
It quantifies the burden in a way that just stating $3.49 billion in debt simply does not.
And building this financial waterfall serves a vital narrative purpose for the overall analysis report.
By structurally showing the math of the cash drain, the final conclusion of the piece, which argues that refinancing the 2026 debt is the ultimate catalyst for the stock, will feel significantly more urgent and logically earned.
Because you've proven it.
If the target audience has just been walked through exactly how the interest payments are the final nail in the coffin of profitability, the concept of refinancing that debt to lower the interest expense isn't just some hopeful, abstract idea.
It becomes the mathematically proven key to unlocking bottom-line profit.
The structure of the argument itself will lead directly to the core thesis. You don't have to tell them, you've shown them.
Well, to wrap things up, this analysis report presents a highly compelling operational narrative for AMC Entertainment.
Like the record per patron spending.
The foundational research is strong, and the underlying thesis is clearly articulated.
Don't forget to like, share, and subscribe for more.